Our next guest has been a key player in the effort to resolve Europe's sovereign debt crisis, which has been behind so much of the market fallout. Charles Dallara is the CEO and Managing Director of the Institute of International Finance. The IIF represents about 450 of the world's largest financial service firms. Charles, good morning to you. We talk about European stocks falling. Banks have been behind much of the recent decline. Why are European banks under attack right now?
I think the pressure on European banks, Erik, is largely a function of their exposure to sovereign risk. European banks, on average, are more than twice as exposed to their sovereigns as American banks are. And you're seeing that their earnings, their underlying capitalization, their overall financial health is reasonably solid. But the pressure stems primarily from exposure to sovereign risk, their own countries, such as France and Italy, and neighboring countries.
Charles, you yourself have been intimately involved in the effort to try and shield these banks from the predations of investors, speculators or investors, it doesn't matter. You played a key role in the negotiations with holders of Greek sovereign debt, and many of those are European banks, of course. And back in July, unless I'm mistaken, you thought that those efforts were going to help restore confidence to the European banking industry and prevent the crisis from spreading to Spain and Italy. Unfortunately, we've seen both of those things play out. People are as concerned, if not more, about the European banks than they were then. And Italy has come under speculative attack. What went wrong?
Well, Erik, I don't think it was so much a function of what went wrong as the focus of concerns has shifted. The deal that was reached on Greek debt is a solid deal. It will come together successfully over the course of the coming weeks, but the concerns are much broader than Greece. The concerns relate to the underlying fiscal challenges that are not being sufficiently addressed in countries such as Italy and Spain.
Are these concerns rational, in your opinion? Is the situation as bad as the markets lead us to perceive?
No. Markets, as we know, tend to swing during periods of excess, and they have overreacted somewhat. But the underlying concerns are legitimate. The governments individually of Europe need to demonstrate more conviction in tackling their fiscal deficits, tackling their debt to GDP problems. But there is a broader structural challenge here, Erik, which Europe faces, which is whether or not they can sustain the euro without fiscal convergence and eventually fiscal unity. So I think market concerns are related not just to near-term problems, but to the broader underlying structural problems of Europe.
Charles, just before break, we were talking about concerns over the future of the euro. And you were saying that, yes, the concerns are legitimate, but not all of what the market is pricing in is rational. What I want to know is, how do you stop the markets from having the upper hand? Investors seem to have the power right now to force governments to do just about anything. Think of what Nicolas Sarkozy and Angela Merkel were talking about the other day. The possibility of fiscal integration in Europe. You raised it yourself. 6 months ago, nobody would have dreamed of hearing those words escape their lips.
Well, you're right, Erik. The question that looms before us is whether or not the pace of fiscal integration will be determined gradually by governments or be determined more forcibly by markets. And I think it's going to be a tug-of-war between the two. I think right now, you look at the individual fiscal positions of governments in Europe, take Italy, for example, or Spain. They're actually making progress in tackling these problems, but the markets have not yet seen the conviction, the timetable, the force and breadth of determination that they are looking for toward fiscal integration, and I think the pressures will continue to be there.
Is there a risk that governments and perhaps the general population grow tired of markets? And we see more of what we saw just play out the other day, the ban against short sales in 4 EU member nations. And then it goes far beyond that, excessive market regulation in an effort to stop the speculators.
Well, of course, there is a risk, and we already see signs of this. And frankly, the regulation that is being put on top of banks these days is an element of that. And the proposals for higher tax increases on financial institutions, which in my view is a very questionable proposal at this time. But the pressures against markets can grow. In the end, however, markets and governments need one another. Governments have to realize that there is no obligation to markets to come in and buy billions of dollars worth of Italian government paper, worth of Spanish government paper every week. That is a market-determined choice. And the governments have little option but to actually strengthen their credibility with the markets.
Well, speaking of buying bonds, the only bid in Europe right now seems to be the ECB. How long can central banks, whether it be the ECB, whether it be the BOE or here the Fed, be the thumb in the dike. How long can that last?
Well, the ECB has been playing this role, and you're right, they're being stretched, Erik. There was an important element of the agreements reached July 21st when we agreed the Greek debt deal that bears mention here, Erik. It is the element that enables the governments of Europe, not just the ECB, to go into the markets and buy government paper in the secondary markets at secondary market prices. This needs to be implemented. It'll be in place by late September, early October, and this will ease the burden on the ECB. However, ultimately, the burden on the ECB is going to need to be eased by some degree of fiscal integration and fiscal consolidation in Europe. Without it, the pressures on the ECB will continue to be there.
Well, the timetable then is the only question. Charles, it's very good to see you here on the Inside Track. Charles Dallara, the CEO and Managing Director of the Institute of International Finance.